So let me start with arguably the most interesting asset right now, which is Bitcoin, which has been decimated from its all-time highs. And there's a couple interesting theories as to why, and this one really caught my attention. The theory is that Bitcoin has been captured by Wall Street using something called synthetic Bitcoin. What does that mean? Okay, so Bitcoin originally traded like a normal scarce asset where price discovery mostly happened on the blockchain, meaning real buyers with real money took custody of their real coins. And that's what made the price go up and down, aka price discovery. And if there was leverage, we could see it on chain because it wasn't securitized just yet. But over time, Bitcoin was absorbed into the traditional financial system. And once that happened, synthetic Bitcoins were created. And so today, the buyers and sellers of Bitcoin are not people that are moving coins on chain. Instead, it's the traders and institutions moving it in what are called derivatives markets. Those are things like futures contracts, options contracts, perpetual swaps, things like that. And this is where you can get exposure to Bitcoin financially without ever touching the asset itself. Therefore, the leverage is not on chain. It's actually invisible. Now, we don't know how much leverage there is until something breaks. And I know that sounds kind of complicated, so let me just give you an easy example to follow. This right here is my birthday Pikachu. There are many like it, but this one is mine. Now, imagine Wall Street securitizes it. First, they create a Pikachu ETF, where the real card sits in a vault and investors trade stocks or shares of it, maybe fractional shares. Well, that alone means that more people have trading exposure to Pikachu without touching the card. Well, then we add futures, right? So that people can bet on where Pikachu's price will be next month without owning it. Then options, so people can speculate on the upside or downside. Then perpetual swaps, so you can go long or short Pikachu with leverage 24/7. Then brokers start lending Pikachu exposure to hedge funds and structured portfolios. They bundle it all inside. At that point, there will be dozens of financial claims tied to one physical card. So the card itself could be like $1,000, but there could be over $100,000 of value exchanged through these derivatives. That's synthetic supply. The card is still rare. There may still only be one, but price discovery is now dominated by paper Pikachu. That's what's happening to Bitcoin. Now, unfortunately, I can't show you concrete evidence like password managers and VPNs, but there's a big gap most people don't think about. The global economy worked off of a debt-based system where growth was pulled from the future. That's why when you look at stocks today, they have something called a forward PE ratio, because the price of stocks you see today are not what companies are actually worth today. They're valued at what their earnings are expected to be in the future. And so investors will pay a premium for it. Now, as long as interest rates stay low and predictable, which today they are neither low nor predictable, the system works really well. If you can borrow cheaply and invest that money into something that grows faster than the cost of debt, you are incentivized, almost forced to do it. It's free money. And a good example of this is Michael Saylor's company Strategy. The whole business model is borrowing money as cheaply as possible because the bet is that the long-term return on Bitcoin will grow faster than the rate or the cost of his loan. That is leverage. Ironically, it's also kind of what leads to the synthetic nature of Bitcoin in the short term. If Strategy really wanted Bitcoin's price to go up, they would buy spot Bitcoin, not OTC, which happens privately, but that's a separate story for another time. The point is, almost everyone in this debt-based system is incentivized to borrow money. It means leverage then spreads throughout the whole system. And this is where Japan becomes a really important part of the story. Because for decades, Japan kept interest rates at zero, sometimes even below zero. Japan became the cheapest source of money in the world, and their capital, or money, flowed out of Japan and into all the other markets. And what that did was a few things, and it sort of explains what's happening right now. The most important thing that it did was it created an environment where leverage, borrowing money, was safe. Because companies borrowed to buy back their own stock, investors borrowed to buy assets, government borrowed to fund spending, and markets got used to this idea that debt could always be rolled over. Meaning, even if your bills came due, you could just roll that loan into another loan, right? As long as the rate stayed low, that works. So how did Japan do this for the world then? Well, for years, Japan made this possible by prioritizing its bond market over its currency. They did that using something called yield curve control. Basically, the Bank of Japan promised the world that their 10-year Japanese government bond wouldn't be allowed to rise above a certain level. And if it did, the central bank would step in and buy as many bonds as necessary to push those yields back down. That kept borrowing costs stable, not just for Japan, but indirectly for the whole world. The trade-off for Japan was a weaker yen, right? Which steadily declined over decades. And that's what people mean when they talk about the yen carry trade coming to an end. Because now Japan is facing a crisis. It's affecting the whole world. Japan has two options. Option one is to defend their currency, the yen. Option two is to keep interest rates low so their debt doesn't become too expensive. but they can't do both. Now, for years, Japan prioritized their bonds, which is why their currency against the dollar has been on a multi-decade decline. They did that strategically using that yield curve control. But now, Japanese bond interest rates or yields are going up at levels we haven't seen in decades. And when yields or interest rates go up, the government has to spend more just to pay for its debt. And Japan has a lot of debt because they buy US treasuries, right? That's our debt, which means stress in Japan's bond market always spills over into the rest of the world. It doesn't just stay in Japan.
I believe the markets are going down because the Japanese bond market had a 6 standard deviation move for the past 2 days. That would be in their 10-year bonds. But that's spilling all over into all bond markets. German yields are up, French yields are up, US yields are up. Again, it's mostly the Japanese bond market.
Now, if the Bank of Japan steps in and starts to yield curve control again and try to lower the rates, it sends a signal of easy money, which weakens the yen, the currency. And a weaker yen makes their imports more expensive and pushes capital or money out of their country. They don't want to do that anymore. On the other hand, if Japan allows yields to keep rising to support their currency, stronger currency and higher rates means higher carry costs, which leads to an eventual deleveraging of the debt-based system. And how that looks like to us is everything goes down. Markets become volatile, especially Bitcoin, which is very leveraged. Now that leads us to part 2 of the story, which is that in this monetary debt-based system, debt only works if the future can reliably pay for the present. But the markets and their values today assume that AI is going to rule the world. AI assumes less workers and less income in the future. So how will this expansionary debt-based system work in a world where AI and robots eat the jobs and the incomes? Both can't be true at the same time. That's the paradox.
Are we at the beginning of a new world order where we move away from Europe and toward anything else? And there's a real question about whether there's a massive shift happening now in terms of world alliances long term.
Well, it's definitely, I think, a new world order. I think the president has sought to it. There's a new world order in trade. There's a new world order in globalization and the way that we invest in our economy versus foreign supply chains. There's a new world order and the president is willing to shake up some old alliance structure.
Let me try to explain this idea using 4 big parts. So, part 1. For the last 80 years or so, the global economy was built on the Keynesian theory of economics. An easy way to understand what that means is that someone has money, you borrow it, and in order to pay interest on it, we have to make more money, aka more debt. That's also why economists call it the debt-based system. Now, in order for that system to work properly, we need cheap money in the form of low and stable interest rates. And we also have to assume the population of the world goes up over time, more people with jobs, and incomes will keep rising, and that the price of stuff in the world would go up slowly at a rate of about 2% per year, aka inflation. Now, low interest rates in this system eventually lead to something called leverage. Leverage is the idea that instead of using only your own money, you borrow someone else's money so you can make even more money. And everyone is encouraged to do that because doesn't everyone want to make more money? So companies take on leverage. They borrow money to buy back their own stock. Investors borrow to buy assets. Governments borrow to fund spending. And the whole system slowly becomes dependent on borrowing and leverage. Now that system works for as long as a couple things stay true. Like for example, it helps when interest rates stay low. That's how debt and leverage spreads through the system. That's also why, for so many years, if you were invested in the markets, everything was good, even though the level of debt was unsustainable everywhere you looked. Well, then there's part 2, which is what about the future of the system? Because the debt-based system only works if the future can reliably pay for the present. That means people need jobs. Society needs to make money, right? The amount of people that pay taxes and pay into the system needs to grow so that economic activity expands. But now it's 2026. And here's what the future looks like.
You've predicted AI will disrupt 50% of entry-level white-collar jobs over the next 1 to 5 years. What does that mean for the future of work, right? If you have a child who's graduating high school, thinking about college, thinking about a trade school, what should the future of America be looking to right now to make sure they have a job down the line?
So that was the CEO of Anthropic. He's telling us that about 50% of white-collar work will be replaced in the next 1 to 5 years. And what that means is that there may not be enough humans in the workforce who will pay into the system, who will keep borrowing money to keep expanding the debt-based system. So investors are like, I've got a question. In a world where robots work and humans don't, who's doing the borrowing and where is the cash flow going to come from? We don't know. That's when this idea of using other people's money, aka leverage, gets a lot more dangerous. Because this can lead to volatility, which leads to deleverage, this cascade of selling, because no one wants to be the last person holding risky assets when we don't know things. And that leads us to part 3, which is the geopolitical story. And what we're seeing right now is the trust between nations getting weaker. There's more uncertainty about what backs the whole system. And so the question is, what is money in this new world? Is it dollars in the form of treasuries? Is it yuan? Is it gold? Is it oil? Is it central bank digital currencies? We don't know.
So debt is a global problem. And I think what the gold rally tells you is markets have kind of run out of patience. They're looking for safe havens.
That's why central banks are diversifying their reserves. And gold is playing a bigger role here. And in a world where no one knows what's going to happen, leverage is not good. And so what happens next?
To top it all off, you've got a more politically tense environment in the US than I've ever seen. I guess the point is, the lived economy is starting to feel very different than the picture the stock market is painting. And that's where we see problems start to occur. So in this video, I want to explain the exact situation that we're currently in, how we got here, and the risk we now face as investors because of this dichotomy. Now, the first thing to remember is that, of course, technically, these are two different things. The stock market and the economy don't always line up. However, they're usually pretty closely related. In a booming economy, stock prices tend to trend upwards, and in a down economy, stock prices typically retract. But right now, we have three really unusual effects happening in the stock market that are distorting it quite substantially. Now, the first is concentration. You've probably heard over the last few years that the S&P 500 is becoming more top-heavy than it ever has been. That's correct, and I want to show you this chart from the Visual Capitalist that really demonstrates this effect. This chart shows what share the top 10 stocks in the S&P 500 index take up. So since 1880, you can see there's normally between 20 and 30%, but as you can see in 2024, that share had skyrocketed to 38%. And I just calculated it for today, and that number is now even greater, 39.21%. So what this means is that actually the S&P 500 is no longer an honest representation of the 500 top companies in America. It is very heavily skewed by the performance of the 10 or 20 largest companies in the country. For example, the S&P 500 as it stands, obviously market cap weighted, has risen around 77% since 2023. But if we weighted every company in the index the same, so 500 companies, i.e. every company occupies 0.2% of the index, then interestingly, the return falls drastically to just 40% in 3 years. Equal weighting gives the index an average 11.6% annual return, so quite in line with historical performance, whereas the index as it stands, being skewed towards the top, has returned 20.2% annually, a massive outperformance. The point is, the major indexes are actually no longer a good reflection of what's happening more broadly in the US business environment. They are more a reflection of what's happening in a select few mega cap tech companies, aka the Magnificent Seven: Apple, Amazon, Nvidia, Tesla, Microsoft, Meta, and Google. And that pretty much leads us straight to the second key reason the markets are becoming detached from our economic reality. And as I was saying, talking about the Magnificent Seven kind of leads us straight to the second reason why markets today feel so detached from our economic reality, and that is speculation. And really, it can be boiled down to AI speculation. All of these Magnificent Seven companies have seen their share prices skyrocket over the past few years, not because their shifts towards AI are bearing fruit, but because investors are just making speculative bets that these companies will be the major beneficiaries financially from the new technology. The one exception here is, of course, Nvidia, who is genuinely capitalizing on the demand for AI hardware, but even in Nvidia's case, they too are seeing heavy speculation in their stock. Now, to show this, the best metric we can look at is actually the PE ratio, because the PE ratio directly compares the share price investors are willing to pay with the earnings that the business is actually producing. So a high PE ratio means investors are paying up to own the stock. Now have a look at this. Historically, the S&P 500 has traded around 15 to 16 times earnings. In the modern era, it's a little bit higher, around 18 to 20. But even considering that, the S&P 500 currently has a PE ratio close to 30. And if you zoom in on the Magnificent Seven companies, many of these businesses are even higher. Google's at 30, Amazon's at 31, Apple's at 35, Nvidia's at 42, and Tesla is around 370. Now, Microsoft and Meta are actually not too bad at 24 and 23 respectively, but still handsomely above that long-term average PE ratio. And what this means is that these massive stocks at the tippity top of the index are not being priced based on their current performance. They're being priced on expected future growth. The problem with that, though, is that it remains to be seen whether these companies will actually be able to generate the returns investors expect to justify the AI narrative. And this is something that Michael Burry has been talking about recently. In this tweet, he shows a chart where he notes that while these businesses are seeing major growth in share price, the growth in their AI ventures might actually be slowing. Have a look at the average growth rates between 2020 and 2022 versus now between 2023 and 2025. So that's the second pillar behind this discrepancy between the stock market of today and the economic conditions or reality that we're actually feeling. The stock market is always looking forwards, but when we look at economic statistics, we're usually looking backwards. So if investors are really euphoric and excited and hyped up about the future, and are willing to speculate heavily, the market tends to race ahead underlying fundamentals, the actual economic reality. This brings us to the third major force distorting the stock market today, which is really the fuel on the fire, and that is inflows, the sheer amount of money flooding into the stock market. During the pandemic, we had what I'd call the gifting of money era, stimulus checks, emergency programs, ultra low interest rates, and that meant millions of people suddenly had extra cash and nowhere obvious to put it. Travel was shut down, obviously spending opportunities were limited, we're all locked down, but at the same time, investing had never been easier. So what did people do? They opened brokerage accounts. Just have a look at a business like Robinhood. In 2019, they had 5.1 million accounts. As of September 30, 2025, they had 26.8 million. Robinhood and now a lot of the brokerage market specifically caters to the retail investor, the everyday Joe. And these days, retail accounts for approximately 23% of US equity trading volume versus just 10%, which is what it was back in 2011. But here's the thing, where does all that retail money go? It goes predominantly into the companies right at the top of the S&P 500, or more likely, it goes straight into an S&P 500 index fund like SPY. And on the surface, that's definitely not a bad thing. Passive investing is simple, it's low cost, it's historically very effective over long periods of time. But when enough money flows in this way, it does have side effects, because when you buy a broad market ETF, you're not making a judgment call on underlying business value. You're not asking whether a company is cheap, you're not asking whether it's expensive, you're just buying, in the vast majority of cases, a market cap weighted index fund, i.e. you're buying a lot of whatever has the largest weight in the index. Because remember, every new dollar that flows into these funds like SPY or VOO or IVV doesn't get spread evenly across the economy. Even though they said it gets diversified, it gets funneled disproportionately into the larger companies in the index. The same companies already driving up index returns. So what you end up with is a bit of a feedback loop. Big stocks go up, they become a larger share of the index, more passive money flows in, and even more capital gets allocated to those same stocks. So all of a sudden, markets keep rising without any fundamental justification. They just rise because capital keeps flowing in on autopilot. So overall, three compounding effects which are really taking the stock market to just new all-time high after new all-time high, even when the economic reality isn't quite as rosy. But what on earth do we do about it? That's ultimately the question for investors, right? For Monish Prabrai, he's not touching the S&P 500. Have a listen to this.
Normally, I would say put it into an index, right? The index, like the S&P, is overheated. We can't go there right now. Circa 2025, we cannot go into the S&P. Okay, maybe 2035 we can, but not 2025.
So Monish sees these factors swelling the market and he says, I'm just not going to touch it. But now have a listen to Howard Marks talking about the exact problem that we've been talking about.
JP Morgan published a chart around the end of 24, and it was a scatter diagram showing over the years the relationship between the S&P 500 at purchase and the annualized return over the next 10 years. The higher the PE ratio you pay, the lower the return you should expect. Makes perfect sense. And it showed there was a number here, 23, on the PE ratio axis, which is what the PE ratio on the S&P was at the time. And it showed that historically, if you bought the S&P when the PE ratio was 23, in every case, there were no exceptions, in every case, your annualized return over the next 10 years was between 2 and -2. That's all you have to know.
And as you can see, that forward PE number as of January 2026 is now 22. You can see that subset of higher PE values Howard was talking about down here, and it's very telling. It shows that historically, when you buy into the S&P 500 at a PE ratio that's just a little bit higher than what it is right now, your subsequent 5-year annual returns are always negative. And you can see the trend of this chart, right? It makes sense. The higher the PE ratio, the more upside has already been baked into your purchase price. So the harder it is for you to generate further returns.
One of the most interesting things about the S&P, if you do the research, and I did it, on average, it has returned 10% a year for 100 years. But do you know that the annual return is almost never between 8 and 12? Think about that.
It kills it or it
dies.
Gets destroyed. Yeah.
Think about what that means. The norm is not the average.
And when you add those two things together, a string of many very strong years in the market that have now bid the S&P's PE ratio up into the high 20s, Howard's point is that if we get a period now of very low annual returns, we shouldn't be too surprised. The market ran ahead, and now it has to wait for the economy to play catch up. Now, of course, I want to be clear, that is by no means a market prediction. In reality, who the hell knows what comes next? But I want to entertain the idea of, say, 5 years of underperformance, because it then begs the question, what the hell do we do? And it sounds like a complicated one, but ultimately the answer is pretty simple. That is, we keep doing exactly what Warren Buffett has been doing for the past 60 years. We forget about the market. We forget about the S&P 500. We forget about the macro. That is just all top-down thinking. But that's not what Warren Buffett does. He is exclusively a bottom-up investor. What does that mean? It means you judge every company on its own merit and you don't make investment decisions based on the broader market, i.e. you take the time to understand the business, you assess the strength of the moat, you scrutinize the management team, and you run your own valuation of that company by itself.